My name is Kurt, and I achieved financial independence at 31 by investing in real estate. This video on cash return is the first in a series that I'm doing on foundational real estate investment concepts that I believe every new or aspiring real estate investor should know in order to thrive. So, cash return is a rate of return metric that's calculated from the total cash earned divided by the total cash invested in the deal. As investors, we must be able to evaluate and compare deals. Cash return is a simple, powerful, and popular metric for doing that. In the second half of this video, I demonstrate its power by covering strategies that you can use to supercharge your returns. This includes the principles that allowed me to scale to 27 units in 3 years' time. Typically, the top of the equation is your annual pre-tax cash flow. That will be the total income minus all expenses, including but not limited to maintenance, taxes, insurance, and loan payments. The bottom of the equation is the total amount of money that you have invested in the deal. This includes your down payment, your closing costs, your rehab costs, your holding costs, and anything else that you have to sink into the deal. Don't be a dingus and include things like appreciation projections in your cash flow calculation. That's like counting your chickens before they've hatched. What you can and should include, however, is actual verifiable income if the property is already rented out, or conservative estimates of what the property will rent for based on comparable properties in the same market. Likewise, exercise care when figuring your costs. Your down payment is easy to calculate. It's whatever you and the bank agree to. 20% is a typical number, but could vary depending on your loan type and terms you negotiate. Rehab costs and holding costs are more complex. Some quick napkin math is valuable for telling if a deal may have potential, but you don't want to proceed on that alone. Be thorough and ruthlessly objective when analyzing your deals. It pays to get actual insurance quotes, rehab estimates from multiple contractors, and remember that the property will be reassessed after you buy it, so your property taxes will likely be higher than whatever the seller is paying. When your deal requires a rehab, account for the high probability that work will take longer and costs will be more than you have been led to believe up front. So a high cash return is a good thing. So that begs the question, what kind of a deal optimizes for high cash return? Well, let's take a look at the inputs, which are income and how much of your money is in the deal. More income will raise your cash return. Having less of your money in the deal will also raise your cash return. If you want to work on the top of the equation, get your rents up to or near market value. Charge a fair price for your property and market that'll attract quality tenants who will pay, want to stay, and not trash your property. You can also make money with laundry machines, storage, garage space, and whatnot. These are all things that I do in properties that can accommodate it. If you want to raise your cash return by working on the bottom of the equation, get your costs down, negotiate a lower price, get your place fixed up and rented out quickly to reduce holding costs, and perform your rehab cost effectively. Only spend money on things that truly add value. Leverage is another powerful tool for increasing your cash return. Basically, the bank loans you money to purchase a property, reducing the amount of money that you personally have to put in the deal. Remember, for a given income, the less money you have in the deal, the higher the cash return, at least when the interest rate is lower than the unleveraged cash return for the property. For example, if you have a deal that yields a cash return of 10% without leverage, and you can borrow money from the bank at 5% interest, you're getting a 10% return on money that you're paying 5% on, resulting in a 5% spread. That 5% spread is your treat for productively deploying the bank's money. It's possible to do deals in which you have no money of your own invested in. This is true of several deals that I've done. In this case, cash return falls apart because, well, you have income with no money in the deal. Going back to our equation, you have either a zero or a negative number in the bottom. Dividing by zero causes the universe to implode on a bad day, or for your calculator to get upset with you on a good one. And to quote Ice Cube, today was a good day. Making money with no money invested is a great goal, and typically is the result of finding a place that you can buy and rehab to have a market value well in excess of the sum that you have into it. You forced some sweat equity. Having all this forced equity means that when you do a cash out refinance, you're getting a sum of money out that could exceed what you put in. This is the key to how I scaled my portfolio, and by subscribing and turning on notifications, you can be informed when I go more in depth on that. Here's a chart that shows what different levels of leverage can do to cash-on-cash returns for a hypothetical deal. Another thing to consider when analyzing deals is that your returns tend to increase over time. This video focuses on year one cash-on-cash return. Well, after a few years, it's likely that your income will be higher through rent increases and that your mortgage expenses will have stayed the same, because that's true of conventional fixed rate loans. If you really want to see what a deal does over time, don't just look at year one, look at year 5, 10, 20, etc. You'll quickly understand why real estate is a great class of asset to buy and hold on to, even when you're leaving some money in the deal. Thank you for watching. I hope this video is helpful. If so, this video is the first in a series on foundational real estate investment topics, so stay tuned for more and have a great day.